Hi, and welcome to Your Finance TV. We're here with Jeffrey Huge, founder at Alpha Insights. Jeff published on Sunday night this week his weekly playbook, which is available on Substack at hugeinsights.substack.com. We're actually filming a little bit later this week. It's actually Wednesday, but there haven't been any really material moves in the market since the note. So, lots to still talk about. Jeff, welcome back.
Great to be here, Mehdi, as usual.
So, Jeff, let's dive in as usual. Let's go top down.
Yeah, last week the S&P was up like 1%. We had holiday shortened trading. We had half day on Friday. Not a lot happened, of great significance. I mean, we got, a couple of earnings reports. We had Black Friday retail sales that came in better. Coming into this week, we have a couple things to look forward to. Obviously, a lot of Fed speakers this week again. We get PCE data, and I think that the market is still kind of hinging on a few interest rate questions with respect to what is the Fed going to do on December 13th, and I think that's one of the reasons we got a late day rally yesterday with some somewhat more positive comments out of Waller. Although I don't think he said anything that wasn't well known at this point. And so we just continue to see more of the same. We've been talking about a complete reversal in the conditions of the market that exist today versus where they were at the October lows a little more than a month ago. And honestly, in some respects, those conditions are more extreme today than they were at the July highs. With respect to advisors bullish survey from Investors Intelligence, which came out late last night. That number came in at 55%. That's the highest bulls that we've seen in some time. It certainly is in the zone where one should be concerned about a high. We've got a number of other sentiment measures that we'll talk about that have completely reversed off the lows by extreme margins. And so, we think that sentiment has now gotten to a point where it is ebullient again. And the market appears to us to have really just traced out kind of an exaggerated bear market rally off the October lows. We think this is an intermediate wave two of a third of, or of a five-wave impulsive decline, which we think will ultimately trace out over the course of the next several months. But if we're right about this being intermediate wave two of primary wave three, then the next wave down is going to be a third of a third wave decline, and we think that will be a powerful decline. We're not, particularly, excited about the notion of a Santa Claus rally. We think that this bear market advance, this counter trend advance off the October lows, pulled a lot of that forward. And in our view, the next move is probably to the downside, and it may disappoint a lot of bulls that are counting on the year-end Santa Claus rally, so to speak. So with that, we're continuing to recommend investors remain, patient and minimize net equity exposure, maximize cash reserves, continue to collect your 5.5% in 6-month T-bills.
So we'll dive into some of the levels later. But you did kick off this week's piece with a very interesting looking chart. And we've discussed CTA money on and off over the last several months. But now you think that that CTA money could be setting up for a sell into year end, as you kind of alluded to in your opening statements.
Yeah, there's a couple of reasons for that, and we'll kind of hit them after we talk about the study. First of all, this was published by Goldman Sachs, an analyst there by the name of Cullen Morgan, who I think is a desk analyst and, follows the CTA money flow data. And, I think from their perspective, their study suggests that CTAs are now maxed out and that the next move is to, liquidate, right? A liquidation into year end. And, they look at it on a kind of a 2 standard deviation up, 2 standard deviation down basis. And, best case scenario is that CTAs remain flat into year end. If that's the best case scenario, then there's not a lot of buying power left because CTAs have been pushing the market effectively. The other thing is that if we look at their worst case scenario, they're looking for as much as a notional $50 billion in S&P futures to be liquidated. And that's not insignificant, to say the least. It would certainly have a market moving effect. So, if in fact this study's correct, and if CTAs do liquidate into year end, I think that's going to be part of the pressure that we see going forward.
So, Jeff, let's talk about volatility. Again, a topic we've touched on regularly over the last several months. We haven't really seen it, and it kind of feels like it's almost drifting even lower than we really thought it could.
Well, yeah, we got a nice pop in late October, right? As the summer sell-off kind of reached its nadir, volatility peaked in the mid 20% range, but it's pulled back sharply, as you point out, over the last month, and not unexpectedly so, as the S&P has moved to levels that are far in excess of what we thought they would experience off these lows initially. So, like I said, a very exaggerated bear market rally. But what we've seen is the VIX push down to levels not seen since 2019, pre-COVID. And I think one of the reasons that the Goldman Sachs study is positioning, or at least expecting a sell-off from CTAs, is because volatility is one of the key drivers. And usually when we get to oversold conditions like we are today, we're using a 6-period RSI on a weekly scale, and we've seen this 7 times before. And in the past 7 cases, each time we've gotten this oversold, we've seen volatility surge over the subsequent days and weeks. And so the extent to which the surge pushes higher is really what's in question. We've drawn a resistance trend line off past highs, and that coincides with kind of the mid 20% range. So I think that's a good initial target where we should expect to see volatility rally into. But I'm not so sure that it's going to stop there. We think that we're long overdue for a real significant volatility shock, and it would not surprise us to see volatility move up into the mid 40% this time around. And if we're correct about our analysis of the S&P 500 index, then that's exactly what should happen as stocks careen lower.
Gotcha. So, Jeff, let's have a look at the Nasdaq 100, and you've highlighted a negative momentum divergence here in this chart. Can you talk us through the implications of this and the bigger picture?
Sure. Nasdaq 100 is really kind of driven by the Mag 7. The Mag 7 represent about 50% of that index by market cap. So, as the Mag 7 go, so goes the Nasdaq. Well, of course, the Nasdaq 100 pushed to a new recovery high last week, and may challenge that level or go higher this week. It hasn't yet. But what was interesting to us is 2 facts. Number one, that new recovery high in the Nasdaq 100 was unconfirmed by any other major index. Okay. The second thing is momentum, as measured by the 13-week rate of change, posted a significantly lower high. And in fact, the last time we saw this sort of a negative divergence occur was when we saw the Nasdaq 100 push to its July high, and the 13-week rate of change made a lower high vis-a-vis its June high. And so that was negative divergence number 1. This is negative divergence number 2. And in fact, the lower high that we just saw put in place by the 13-week rate of change last week was much lower than the highs that we saw in both June and July. And therefore, we're calling this kind of a double negative divergence. So when we see this, it tends to be more powerful and more predictive. And what's interesting is the last time, the first negative divergence we saw, it was attended by a 12% decline in the Nasdaq index over the subsequent 3 months. So, the magnitude of this negative divergence and the fact that we're seeing kind of a double negative divergence, we think the magnitude of the decline could be more significant than what we saw in the summer. So we think, certainly negative divergences can be resolved, and they have been resolved in the past when these conditions exist. But more times than not, this is a serious warning signal of an impending trend change. We think that's exactly what we're likely to see going forward.
So let's have a look at the cycle composite, our old friend, the cycle composite. So it's kind of been a great bellwether over the last, several months and years. But are things poised for a bit of an inversion here?
Yeah. So first of all, a quick explanation. The cycle composite is really just an aggregation of three key cycles. It's the 1-year seasonal cycle, the 4-year presidential cycle, and the 10-year decennial cycle, equally weighted. Ned Davis Research has been publishing this for many, many years. This is based on history going back to 1928 in the S&P 500 index data. And so it's basically giving you a historical aggregation of how stock prices have historically trended and how they should trend going forward. Well, as we've seen year to date, the S&P 500 has tracked very, very closely to the cycle composite in terms of catching the twists and turns, right? The magnitude of the change is almost double what the cycle composite was forecasting, about a 10.5% return, but the S&P's returned around 20% at its peak. And so, we certainly have that sort of disparity between the two. But usually the peaks and the troughs of the cycle composite have been lining up very, very closely with the peaks and the troughs of the S&P 500 index itself in real time up until this particular change, which is forecasted as a late November low. And it appears that instead, the S&P is going to make a late November high. We've also been looking at the Montgomery cycle turn day data. We were surprised that the November 13th turn date came a day early and marked an interim low on November 10th. We had actually, from that point, been looking for a low on the November 27th turn date. It appears that we're going to post a high on that turn date plus 2 trading days, which is typical. Montgomery cycle is usually plus or minus two trading days. And so if in fact we were to make a new high today, new recovery high off of the October lows, it would still be within that turn date, cycle kind of range of plus or minus 2 days. And so, I think the inversion is really just something that occurs from time to time. It's not uncommon. It's not super common, but it is interesting. And if in fact we do see the cycle invert and make a high as opposed to a low, then the next directional move should be to the downside. Now, I also want to mention, there is another very well-known market forecaster by the name of James Dines. The late, great James Dines passed away last year. He is known best for his the Dines letter forecast. And he used to keep kind of a set of market rules to live by. And one of those rules was that, basically whatever happens in October, expect the opposite to happen in November. But whatever happens in November, expect the opposite to happen in December. And he kept a scorecard on this rule. And that was accurate 84% of the time since 1957. So, for what it's worth, we did have a big upside move in November, the opposite of what we saw occur in October. And I think we're setting up for a top right now. And based on Dines' historical rules, we should expect the opposite to occur in December from what we just witnessed in November. And that would be a sell-off. And so it all dovetails with the other work that we've presented here today.
Those are some very interesting odds, 84%. That's crazy. So, Jeff, let's have a little look at the technicals. Where are we on the primary degree Elliott Wave analysis?
Yeah, we think that the July 27th high marked the peak of primary wave 2 up. We had been counting the 2022 bear market into the October 22 low as being primary wave 1 down. And so we think the decline off of that July high was the early innings of primary wave 3 down. So as long as we don't take out that July high, that assumption holds. Now, where are we in the count? Well, we think the initial decline into the October 27th low was intermediate wave 1 of primary wave 3 down. What we've seen since is a 3-wave counter trend advance. It's been a sharp, extended sort of advance, retracing, I think, somewhere around the 88% range at this point. Not impossible. Second waves can retrace up to 100%. They just can't exceed the prior high. And so as long as we hold below that July high, we can continue to assume that this is intermediate wave 2 up. And once intermediate wave 2 up terminates, then what will follow is intermediate wave 3 down of primary wave 3 down. We call that a third of a third wave decline in Elliott Wave parlance. It would tend to be the most powerful, the most dynamic wave setup in the Elliott Wave impulse count. And as such, we would expect a rather terrific decline to develop from that. So where could it go? We've kind of been targeting S&P 2775 as kind of our primary wave 3 low. That will not complete the impulse wave off the January 2022 top. That would actually extend somewhat further. We'll need a 4th wave corrective sort of waveform. 4th waves tend to be lateral corrections. They're more of kind of a supply-demand rebalancing, and then a 5th wave plunge into what we would define as cycle wave A down. We expect cycle wave A down to bottom around S&P 2250 or so. That's the 61.8% retracement of the 2009 to 2022 advance, that 13-year advance. So this would be occurring, basically over the course of a number of years. We do not expect to fully correct the advance that we've seen into the 2022 high in just a couple of months or a couple of years. We think that it's going to take more than a decade possibly to correct the full extent of this advance. And as such, we're looking for a very powerful recovery off of that 2022 or that 2250 low that we're talking about in the S&P. We think something like a 50% retracement, which would be cycle wave B, and that'll be followed by cycle wave C down, which could carry the index dramatically lower. And rather than throw numbers out there, we'll just stick with where we are in the count. We think the next big move is to the downside.
So, Jeff, you also in this week's piece, you have more Elliott Wave perspectives. Can you talk us through this as well?
Yeah. We've decided to spend a little more time looking at the equal weight S&P 500 index. And the reason for that is the Mag 7 now represent nearly 29% of the S&P 500. And so, their performance has skewed everything in that the concentration of their exposure to the S&P has skewed everything. And so by equally weighting the index and looking at the waveforms from an equal weighted perspective, they are much more traditional, okay, in the way that they're tracing out an impulsive decline. The decline off the July 27th high into the October 27th low is a clear 5-wave impulse pattern at every degree of trend, whether it be minute wave, minor wave, or intermediate wave. And so that marks intermediate wave 1 down. The counter trend advance off of that October low is a clear zigzag, an ABC, and it's nowhere near as extended. It is much more proportional in both time and distance, and has retraced less than a 61.8% retracement, which is typically what we'd expect. That's the Fibonacci golden ratio. It is more often than not the standard retracement that we'd see, but usually somewhere between 1/3 and 2/3. But a 61.8% retracement is not unusual. And so we're holding just below that. And it looks to us, again, that the market is positioned for the next leg down, which fits that count perfectly. So, that's really the point that we're making with the equal weight index. The other thing that we wanted to highlight within that study was the momentum measure that we're using below. We are using kind of a more traditional momentum study and slow stochastics, and that is putting in a negative divergence that is, quite considerable over the course of the last, say, 13 trading days. And so as we see the S&P equal weight index, push to a new recovery off of that October low, momentum is making a lower high. And that negative divergence, again, is indicative of an impending trend change. So, it gives us a lot of confidence that our count in the cap-weighted index is correct as well.
That's great. Thank you for that. So Jeff, all said and done, we've looked at all the market sides, the levels, everything that you're seeing. But how is investor sentiment looking?
Yeah, and sentiment has really reversed off of the lows that we saw. We saw some extreme fear readings back in October. If we look at the name exposure index, the name exposure index got down to 24% net equity exposure, one of the lowest we've seen in recent years. And just over the course of the last month alone, we've seen a complete reversal from 24% to 78%, which is a pretty fully invested number for professional investors. In addition, if we look at the individual investor survey, the AAII survey, bulls today are 45%. That is a complete round trip from where they were in the low 20% back on the October 30th survey date. And bears are now 23%. They were about 48% back on October 30th. And so if we look at the bull-bear spread today, it has moved to positive 21.7%. That is up 47 percentage points from where it bottomed. So, we were down at like negative 25.7 on the October 30th survey. So a complete reversal there. And so, we think this shifts conditions in the market. The setup here is one of an extended overbought market that's losing momentum with extreme greed built up and optimism built up in investor sentiment. Again, I mentioned earlier at the outset, the Investors Intelligence Advisors survey just came in with 55% bulls. Again, a very, very high reading that tends to mark major turning points at tops, essentially. So we should be looking for a major trend reversal from current levels here.
So Jeff, before we wrap, you obviously have your micro pitch where you pick stocks. You have your top actionable trade ideas, 5 longs, 5 shorts. So I'd encourage our viewers to sign up to your newsletter. But before we do actually wrap, are there any sectors of choice going ahead, that you would like to position yourself in, and any standouts from a relative strength basis?
Yeah, so let's just recap the last month. Off those October 27th lows. The rally has been led by technology, communications, and discretionary. Those have been the dominant forces. We've also seen a pretty strong dead cat bounce from financials and REITs, but that to us does not look like it has any sort of durability to it. We think that we're likely to see the next phase of rotation shift away from tech, comm, and discretionary and into defensives. In fact, utility staples have been stabilizing for the last month and now appear to have resumed, an improvement track in terms of their relative strength. Healthcare has weakened quite a bit from where it had been, but it's still positive and still in kind of the improving quadrant. And so, our bets are simply this, that it's going to be utilities, staples, healthcare, energy, and gold stocks that rotate positively, and that tech, comm, discretionary, and financials are going to fail miserably. We'll see a significant reversal in their current momentum going forward. And so, I think now is the time to reposition from a sector rotation positioning perspective, from aggressive growth to defensives. And that's really where we're placing our bets right now going forward.
Brilliant, Jeff. Defensives it is. As always, really thank you for sharing your thoughts from Alpha Insights.
Always a pleasure.
And I want to encourage our viewers, make sure you check out Jeff's content on Substack at hugeinsights.substack.com. And obviously, we'll have the big monthly piece coming next week, next few days as well. So make sure you sign up for that. Until next time, thank you for watching and good luck investing.